Welcome to Looking at the Markets with David Modell. Today I'm going to give you a very brief and introductory explanation of Elliott Wave theory. So let's go. First, let's start with fractals. That's a neat pattern, right? Well, let's take a look at it. If you'll notice, I don't know if you could see it on your screen, but focus on this medium-sized swirl here. You might notice that the medium-sized swirl is made up of smaller swirls of the same shape. And each of those smaller swirls is made up of even smaller swirls of the same shape, and so on, infinitely, smaller and smaller. And it goes in the other direction too, infinitely. These medium-sized swirls, when you put them together, make up a large swirl, and you can't really see it, but each of these large swirls, when you put them together, make an even larger swirl, and so on. Okay? So they're infinite patterns, and those are called fractals. Pretty cool. And we're going to talk about that later. But first, let's introduce this man. Many years ago, Ralph Nelson Elliott developed the Elliott Wave theory, which proposed that stocks and markets are not random and don't just go straight up or straight down. Instead, they move in recognizable cyclical patterns. They go in cycles. According to the theory, stocks and markets infinitely repeat in 5-3 cycles, 5 and then 3. First, 5 impulse waves in the overall trend or direction. So imagine a stock or a market that tends to go up over time. Well, you've got 5 impulse waves, and they're like stair steps or zigzags, but we're going to call them impulse waves. So here they are, 1, 2, 3, 4, 5. 5 impulse waves. And those are in, they're going upward here. That's followed by 3 corrective waves. Let's count them. 1, 2, 3. 3 corrective waves going against the overall trend or direction. In this case, they're going down. So 5 impulse waves followed by 3 corrective waves. And then it would repeat infinitely. So that would be followed by 5 impulse waves, then 3 corrective waves, then 5 impulse waves, and so on. Now, because this is fractal in nature, remember we talked about that, each wave is itself divided up into smaller waves, shown in the picture below. And I tried to draw this as best as I could. I hope you'll forgive my artwork. But you'll notice, you can see the 5 impulse waves, and each of the waves is itself divided into smaller waves. Those smaller waves would also be divided up into even smaller waves, too small for me to draw, so you'll just have to imagine it in your mind, and so on. Okay? And also the corrective waves. 1, 2, 3. Those 3 waves are each divided up into smaller waves. And each of those little waves would be divided up into even smaller waves, and so on infinitely, according to the theory. Much like the fractal pattern I showed you at the beginning. Also, because this is fractal and infinite in nature, each 5-3 cycle is itself part of a bigger overall 5-3 cycle, and so on. Alright? So if we go back, what I did was I took this piece here and I shrunk it, alright, and I put it here, and then I repeated it, and I made a bigger, out of this medium-sized 5-3 pattern, I made a bunch of them, strung them together, and made a bigger 5-3 impulse wave. And then I didn't have room here, but you'll have to imagine in your mind that it would be followed by a corrective wave. 1, 2, 3. And so on. So let's use a real-life example. This is Starbucks, the daily candlestick chart. And we can see, and it's not picture perfect like the drawings might be, okay? But you get the idea here, because you can see, all right, it goes up, and then it retraces, but not all the way, maybe most of the way, but not all the way. And that's part of the theory. It should not go down further. Okay, it should not just keep going and going. It should only retrace partially. And then it should go up further above the previous high here. It should make a higher high and then retrace, but only partially. It should not go down all the way. So it retraces partially, and then another higher high. And so here we are. 1, 2, 3, 4, 5. The impulse wave. And we might expect it to be followed by a corrective wave. And so here we go. Down, and then up, but only partially. It doesn't go all, it's not another higher high. And so we might expect the next move to be down, if the theory is to hold correctly here. And I would not expect to use this theory exclusively as my only charting tool. You want to use your own due diligence. You want to think for yourself and use other indicators, use your own research, investigate the company, okay, or commodity or stock or index or whatever it is. And don't just rely on one indicator. This should be one of your many tools in your toolbox, so to speak. All right? But this was just an introduction to Elliott Wave theory, and you can investigate it further for yourself if you want to learn more. All right. So I hope this was helpful to you. I took something complex and just tried to make it as simple and easy to understand as possible. Alright, so if this was helpful to you, please give this video a thumbs up on YouTube and leave comments, and please subscribe to my YouTube channel so you can receive the latest updates on my financial educational videos. And if you'd like some help with technical indicators or fundamentals, trading, investing, stocks, options, whatever it might be, you can email me at any time. My email address is davidmodell@gmail.com. Thanks a lot for watching and listening, and I'll talk to you again soon.
It's different now.